Hi everyone! We're doing the bottom-up approach to pricing. In my group, we have Alexis, Josie, Josh, and me, Patricia. Now, Josie will come up and explain to you the steps. Alright, so the first step, we're just going to do the calculated desired net profit after tax, and this is usually found in the question. For the next step, you're going to calculate the net profit before tax using net income after tax, which is the net income that you found in the question, divided by 100 minus the tax percent. Next, you're going to calculate the tax in dollars. So this is an optional step, but you should probably do it. And it's the difference between the net profit before and after tax. I have to take the net profit before tax minus net profit after tax. The next step is to calculate the total fixed costs in dollars. Next, you're going to calculate variable cost percent. And lastly, calculate the total revenue needed, which is a fixed cost plus net profit before tax divided by 100 minus the variable cost percentage.
So we have an example. The example is you're the owner of a restaurant and your monthly goal is $50,000 after tax. Your expenses are income tax rate is 5%, fixed cost is 10% a month, and variable costs are 70%. So most people like to fill this in on a table. First step is you have to find your net profit after tax. The problem gives you this and it is $50,000. The second step is to calculate net profit before using income tax and after tax. So what you do for the second step, you take 50,000, divide it by 100% minus 5% for our tax, which you could also just write as 95%. And that will give you about 52,632. Our tax was 5%. The third step is to subtract 52,632 from 50% to make sure you got the correct amount. Our fourth step is to calculate fixed cost, and for this problem it just gave it to you, which was 10,000. The fifth step is to calculate variable cost percent, and it was also given to us in this problem. And we know that contribution margin is 100% minus variable cost, so we can go ahead and fill that out for 30%. Now for the sixth step, we want to find out what our sales revenue is. The formula for that is fixed cost plus net profit before tax over 100% minus variable cost percent. So that would be 10,000 plus 52,632 all over 100% minus variable cost percent, or just contribution margin, which is 30%. That would give us a grand total of 208,773. Now to fill in the rest of the table, it's pretty simple math. You'll just take your sales revenue and then times it by the percentages. Then if we round to the nearest dollar, for variable cost it'll be 146,141, and then for contribution margin 62,632. And here is all the math just in text form.
Here are some other examples you may come across. If something says the depreciation rate is 10% of $220,000, then you would times $220,000 by 10% and add that number to the total fixed cost. Then if something says a 20% after-tax return on a $220,000 investment, then for the net profit after tax, it would be 20 times the $220,000. Also, another example would be, for a variable cost, it will give you a few different percentages. Just add them all together. And if it's a fixed cost, it will give you a couple of different costs that you have to add together. Make sure they are fixed costs, rent, salary, utilities, etc. Sometimes it will want you to find a profit for a year and it'll only give you a cost per month. You then have to times that by 12 and you'll get your answer. For more information, look at page 149 of the book for reference.